you should be contacting your Congress people. This is ludicrous.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. This is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and as you can see, I'm out of the vault today in Costa Rica paradise, and I'll be your host for this week's episode. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets, and we expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you knowledge and understanding that the mainstream media won't provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, as you can see here, I'm in beautiful paradise, Costa Rica. Now, we usually start with a quick update of the short-term action in gold and silver since our last episode 2 weeks ago. Can we start here, please?
Well, great to be with you again, Shane, and with all our subscribers. My goodness me, I try to fit this stuff into a short period of time. I've had to put stuff aside, but there's some big stuff coming. Anyway, let's get into it. Yeah, Shane, I mean, look, it all makes sense. We've got to do this. We've got to connect the dots. And following this last 2 weeks of paper market driven action again, since our last episode, which culminated into the obligatory deliberately generated non-farm payrolls volatility, which was last Friday, which is always a gamed event. Under the paper market smokescreen, the very large unleveraged central bank spot gold orders that we talked about at 1950 have and are being triggered in very large size. So now, with non-farm payrolls now largely in the rearview mirror, CPI coming up tomorrow, let's look at some, and we're recording this on Wednesday, let's look at some fresh inputs alongside really what to expect as we move further into the thinnest 3 weeks of holiday market trading of the year. Now, which really counter to the momentum-driven, paper-driven action, which we're going to look at in a minute. Given the structural paper to physical imbalance, liquidity providers assess this may ultimately surprise to the upside into the month end, while the majority of traders and skeleton staff desks are either still wrong-footed or on the sidelines. So to answer your question, Shane, before looking at the medium and long-term bullish gold drivers, let's start by looking at the short-term action and what it revealed. Now, obviously, if you're a trader, you'd be more interested in this, but it's good to know the picture, how it all fits together. We commenced August trading with a natural rally following, if you remember, we had this big derivative-driven options mark-to-market event, and then really we then went into the first notice August flows. So in other words, the August contract moved off the board and went into delivery. And what we did was we pre-warned that these trade at settlement off-ramps, deliberately disruptive ones. So once they've been squared and August gold moved into delivery on Monday the 31st, what we did was then we anticipated a little bit of a large year-end physical-driven rally to develop from this unnatural discount. This is a paper market discount. Now, if you don't know what trade at settlement is, then you need to go back to some of the episodes, but really it's a spread position, which should be neutral, but is actually gamed by the insiders, the cartel, really by selling short of future contracts, say with a big premium, say $40, and then literally buying an offsetting front month position. But really it's about the disruptive way they exercise that. And it's illegal too. Now, what we anticipate, though, is following all of this is a very large year-end physical-driven rally, which we will look at very shortly. We did expect cap ranges into the end of the month. However, the non-farm payrolls dip and follow-through spec-driven selling, which has continued, has provided stackers and central banks a big reward for being patient. And par for the course, because we still see the COMEX tail wagging the physical market dog, the net bearish COMEX gold and silver futures defined ranges, now these are paper ranges, have been pinned at the bottom of the speculator determined ranges with rises capped. But of course, the house insiders exposed to off the grid, outside the casino, hard asset physical market offtake, as always is the case, are taking the long side of these relied upon, tricked in speculator capitulations. And without these speculators, the counterintuitive jig would already be up. But importantly, as we've been drawing attention to, we're also seeing a split in the speculator group, which commenced following gold morphing into a first-tier competing asset class in January. Now, what this means is that even paper gold is beginning to evidence gold being employed really for what it says on the box, which is fire insurance against risk assets, which increasingly also means actually US treasuries. And that's going to be a subject we look at in a minute. So bottom line, this means an ever larger group of speculators will emulate what we're seeing in the real physical markets, namely these COMEX-centric speculators that are contained inside the casino, forced to stay inside the casino because they're banned from trading the over-the-counter physical markets. Obviously, you can buy physical, but you can't trade the over-the-counter markets, which are physical. So what they're doing is the specs inside the casino are holding these paper gold hedges, and this is the split group, into situations such as we're just witnessing. When the market woke up, in particular, what we see was when the market woke up to Fitch blindsiding the Fed and Treasury Secretary Yellen, downgrading the US from AAA to AA+, and then it spooked the risk markets. So, gold really doing what it should do on the box. However, following the surprise Fitch US downgrade last week, which should have been very bullish for gold versus the dollar and treasuries, obviously, coordinated official interventions immediately pushed back against the downgrade, evidencing officials aggressively intervening in the foreign exchange, dollar crosses, all of them, which of course includes gold and silver. Officials actually admit to intervening in the foreign exchange markets. But in a situation like this, which of course includes gold and silver, in a situation like this, really counterintuitive action to what should have been happening. And while we expected to see some continued short-term official pushbacks against this US downgrade, if that wasn't enough, Moody's followed through downgrading 10 US small and mid-sized banks with an indication that the larger banks, yes, the big guys, that downgrades will follow for the big guys. Now, this drew in some fresh Fed-driven interventions, jumping into to prop the dollar up. However, these downgrades what they've largely resulted from is because of the pace of higher rates, which under the official line of rates higher for longer, which we see the Fed officials talking about, or many, it means that officials are walking a tight rate tightening, really, tightrope, with particular concern over the small banks holding actually over 80% of the underwater high-risk commercial real estate sector loans. Now, this we talked about this before. This is the next bank shoe to drop, and it undoubtedly has the Fed's attention, especially as there is the pace of interest rate rises that caused the problem in the first place. So to understand exactly what we're currently evidencing into what is undoubtedly official interventions, which explains exactly the counterintuitive action we're seeing, the US Fitch downgrade from AAA to AA+ it roiled the dollar crosses immediately, spiking rates higher, and with over $1 trillion in US debt that has to be sold in the third quarter to finance US government borrowings, we've evidenced a coordinated official intervention to prop up the dollar against the foreign exchange crosses, which again include foreign exchange gold. Now, as an asset class, first-year gold increasingly competes against US treasuries. Hence, the verbal pushback from Yellen and the White House, of course, coordinated with a hard currency official pushback and intervention, particularly focused on, and what they were focusing on was the net stable funding ratio compliant foreign exchange gold cross, which crosses with the COMEX. But of course, what they did was generate what the Fed generated was paper gold inside the leveraged, non-compliant, cash-settled COMEX exchange. So again, the tail wagging the dog. But we're going to talk about how that's a bad choice. Net of what gold supply can be flywheeled against the specs inside the COMEX exchange, this is accruing a large overhang of what we call T+2 physical demand, i.e. you buy a spot gold position, it has to be fully physically backed, it has to be delivered within 2 days, or you default. And that's what Basel III NSFR conditions brought in on the 1st of January. So this large overhang of physical demand outside the casino in the global delivery markets, it cannot be offset against the specs. So what can't be offset against the specs? So is going to have to be delivered. And this ill-advised official pushback is now compressing what we see as a coiling physical to paper disconnect into deeply oversold technical and fundamental conditions. Now, this can be partly evidenced by some offsetting spot gold demand into the propped up dollar and bond gaming. And so we're seeing sessions where we're seeing gold actually not really reacting to this wall of dollar buying. Now, while related silver is, of course, while it's in demand in India, it's suffering against the rising dollar index weight, much more than gold. Silver is also now deeply technically oversold, with the swap dealers and the producer merchants, i.e. the cartel members, on the long side of what is a bid-pull range, i.e. they're not shorting the product, they're just making markets and pulling bids and causing air pockets. Now, gold, for its part, it's important to know this, it needs to overcome the spot-related 1950 level at around the futures price of about 1984, 1985, where a layer of sideline central bank buy stop orders are reported to be sitting in the spot market. And it's also noted that large central bank spot orders sit at the equivalent gold futures 2005 level as well. And because currently the contango, i.e. because the December price is about $34 higher than the spot price, because obviously you've got this duration. But it notably into dips, it's contracted to as little as $29, which it certainly did into the non-farm payrolls dip.
Andrew, in our last episode, you drew attention to how gold as a first-tier asset class is increasingly competing against the U.S. treasuries. Now, before we started recording, you were talking about how this has got the Fed's attention. Can you expand on this?
Yeah, Shane, this is really important as it's not factored in. Let's look at the most recent example, shall we? I mean, given that first-tier gold now competes as an asset class against first-tier treasuries, which following the unexpected US rating downgrade, treasuries were being heavily sold off, it was spiking the yields higher. Concurrent elephant-sized footprints were evidenced selling leveraged COMEX gold futures, clearly demonstrating they were being intervened into when gold should have been rising. Now, the panicked coordinated Fed Treasury official intervention, and we'll explain why this really revealed a very weak flank for them shortly, what it did was evidence officials aggressively naked short selling gold futures, not bid pulling, naked short selling gold futures to inversely fund pumping up the dollar. But given that the sheer scale of this paper supply, despite officials' best efforts to actually naked short sell COMEX gold in favor of propping up the dollar, off grid, outside the casino, that is, competing but unleveraged physical demand is partly offsetting a good degree of really this enormous wall of naked short supply, but not before large central banks spot Basel III compliant orders at spot 1950 were triggered. Now, the large physical bullion outflow is overhanging the wall of paper selling, and this huge wall of paper selling, but it's paper. And when momentum is lost in the paper market, very similar to when the Fed interventions receded or had to recede back in November 2022, a physical price will have to be paid. And not all of this will be able to be offset against the split in the spec category, the speculator category, and contained inside the casino. This is the point we're trying to make. It can't all be settled. This is a bad decision. Obviously, very short term, when we evidence a wall of leveraged cash settled, non-deliverable paper gold supply being unleveraged, one-to-one backed, being met by unleveraged, one-to-one physically backed gold outside the casino, it temporarily distorts the real supply-demand picture, which, given the Fed had very little option but to throw the baby out with the bathwater, this bleed of open interest, this bleed of chips, casino chips, into the physical market is 100% certain to bite them back, just as it did when the Fed got so wrong-footed back in November 2022 when gold was priced at $1,818. The current structure is approaching a very similar condition to when this November low was made, when, unlike the Fed, who was myopically focused on propping up treasuries into the worst bond year in American history, right on cue, and at the expense of the Fed, the Bank of International Settlements finally finished squaring up all their paper gold derivative exposure, evidencing gold becoming that was the point when gold bottomed out at 1818, triggering a physically driven naked short covering spree that topped over $267 higher into the 2085 level.
All right. Now, Andrew, you also mentioned that the COMEX Commitment of Traders report, which many people rely on, is designed to wrong foot as many speculators as possible. Now, we had some questions about how the commercials or the house are currently positioned against the speculators. Can you elaborate on this?
Yes, Shane, we've looked at this report in past episodes. This siloed, deliberately house-delayed COT report, which is really the report, which is everyone, all the specs rely on this report to make structural trading decisions, is deliberately delayed from being released for an unimaginable 3 full days, despite the data being available to insiders at close of business every day. So the 3-day delay is rigged. And in this case, the last published report, recording this on Wednesday, was on Friday, the 4th of August. And that only captured the Tuesday, the 2nd action. This is ludicrous. This is, I mean, for someone has not jumped on this, amazes me. You should be contacting your Congress people. This is ludicrous. What it does is catches this report, even though it's all the way back to the 2nd of August, and we're now on the 9th, and we're still relying on that report from the 2nd, which is ludicrous. It still catches some of the house short covering their footprints. But of course, it fails to capture the very large invisible hedges to these shorts, which are evident and in the physically deliverable net stable funding ratio compliant local London foreign exchange gold market. So while it looks like the insiders are structured against the speculators in their net positioning, Historically, it spooks them out. In fact, the House insiders are hedging longs on the other side of these COMEX spec short sales. Not so the Fed. But also by design, being deliberately 3-day delayed, we say, the bearish-looking report, it doesn't capture the much larger spec capitulations into that last Tuesday cutoff, but their footprints are impossible to hide in the wholesale market. And we know they are positioned for, the insiders are positioned for higher gold prices. So what this action reveals is that the counterintuitive Fed whale footprints is that the Fitch US downgrade blindsided the Fed, triggering the Fed to intervene in all the foreign exchange crosses, which include gold and silver, crossed against the dollar. Now, ironically, because the dollar is the least dirty shirt in the laundry bag, the US downgrade resulted in a large risk-off, safe haven race into the dollar at the expense of all of the other crosses. That was the object. The dollar index short squeeze gained traction, weighing on every single asset class. And that's what we see after that, what the dust will, as the dust settles. And while the counterintuitive official action pulled the trigger on safe haven gold and silver futures, Asia, along with central banks, are confirmed to be all over the COMEX-driven paper gold and silver discount. Now, liquidity providers verify that under the smoke and mirrors COMEX-driven action, large unleveraged central bank safe haven physical gold orders have been filled. The leveraged momentum driven gold and gold futures sell-off drove deliverable foreign gold directly into a very large central bank accumulation zone that we identified in our last episode was sitting at 1950, whereas before it was sitting at 1900. Now, there is little doubt insiders exposed to a huge overhang of impending T+2 delivery exposure are on the long side of every tricked in inverse dollar to gold sell order. And while spot gold was ring fenced in London to hide this very large T+2 demand flowing in at every London fix since then, far larger central bank monetary physical gold orders were filled off grid. We talked about this before. Strong demand and premiums in China aside, under the radar, we've been reporting increasing volumes of physical orders that are benchmarked at the London fixes are flowing through and being physically settled in the increasingly liquid Moscow and also Moscow Futures Exchange, where Russia is evidenced to be once again fulfilling a fresh mandate to accrue physical bullion and are prepared to pay a premium even with a weak ruble over deeply undervalued London spot gold to get it.
Andrew, you had a little teaser ahead of the BRICS summit. Can you share with us?
Yeah, Shane, it's just a little teaser ahead of BRICS summit on the 23rd to 25th of August. And now I'm saving a very important announcement until our next episode, which will be released during the BRICS Plus summit. This is big central bank news. That's all I'm going to say right now, guys. So hold tight. But this brings us on to the BRICS Plus currency developments, Shane, that we've been talking about.
Exactly. Now, Andrew, you have been closely tracking the development of the much suppressed mainstream media, BRICS Plus gold-backed commodities currency developments. What are you hearing?
Now, for this, a big thanks to Vadim, who I met on the streets in Zurich, for bringing attention to Sergei Glazev's update while he's on holiday in Russia yesterday, while Sergei is on holiday in Russia yesterday, where Glazev outlines, as it translates from Russian, his new method of settlement in the international trade between BRICS countries. That's his words as translated. Now, he updates that for the participating countries are forming, as his words, are forming the experts group that are working on the new currency unit, creating a sanction-proof mechanism to settle the trades between participants in parallel to existing methods. Now, he mentions that they created a model that sets up two baskets of currencies serving two separate purposes. The first one consisting of the national currencies similar to the SDR, encompassing a balanced basket weight formation. But the second basket really has our attention, as it consists of the most liquid commodities, including gold, comprised of a basket of 20 of the most liquid commodities from oil to grain, including a gold anchor. Now, Russia produces all of these commodities, including gold, which in aggregate will provide a stable index to benchmark a new world currency such as would suit the BRICS Plus or the BRICS Development Bank, all seamlessly settled on the trustless blockchain. He also outlines what he calls a new world economic order, creating a sufficiently liquid, and this is the key, liquid world settlement currency, where these digital national currencies will be settled by bypassing banks and in turn attracting thousands of brokers to make markets, thereby bypassing sanctions. Now, not only does he discuss bypassing sanctions, he illustrates how this pricing platform circumvents the current Western commodity price setting monopoly. Now, to that end, he provided an example of the Ukrainian grain deal imbalance, where Western speculator-driven markets were able to buy the grain 2 times cheaper than they sold it for, while Africa is starving. So there's a social side to this. And Glazev says that this currency has already largely been agreed by the BRICS members, with India and China officially watching from the sidelines. However, feedback from our good contacts in Russia indicate no opposition and a readiness to participate once it's ready to roll. Now, by next year, BRICS conference will have Russia presiding over it. And it will likely formally announce these already developed new currency units being launched. But subscribers will also recall Sberbank already trialing digitally backed gold on the Seller blockchain at the open of January trading. In fact, our very first episode of 2023 brought that to light. And we have reports that this element has become part of the process and is now fully functioning, trialed and working. And as we've been reporting, in spite of weakness in the ruble, tremendous weakness in the ruble, because of this dollar ramp and interventions, it's no coincidence that Moscow spot gold futures trade tick for tick at a $2 to $3 premium to local London gold, and that the Moscow physically settled futures market is matching an average $3 premium over the December COMEX futures. In fact, what we've evidenced in when we've seen imbalances is up to a $14 per ounce spot premium, which quickly gets arbitraged, and up to a $17 future premium which we saw into the end of the month COMEX driven August gaming when we moved into first notice at last month end. So, quickly arbitraged. It is becoming very liquid. And as we have also identified, this is enabling Indian buyers, for example, to circumvent the CME LBMA ring fence, while taking full advantage of the gamed global PM fixed prices that benchmark real physical exchanges. So aside from this noted large increase in Indian gold smuggling that we talked about last time, far in excess of the World Gold Council estimates of about 30 tons a month, this alternate Russian physically backed spot gold exchange is facilitating large Indian flows to bypass London, largely through Dubai, ultimately flowing into Russian and ultimately Chinese central bank vaults. Now, liquidity providers also report off-grid settlements bleeding into all the physical exchanges, all benchmarked to the two London COMEX diluted PM fixes. And given the consistent spot premium offered by Russia, This lack of Asian market flow through the rigged LBMA London fixes is misinterpreted as a lack of interest in gold. Big mistake, whereas these flows are and will increasingly be facilitated through other channels as they evolve. And first-year market-making banks will be aware of this, whereas the Fed and the only central bank still short gold is once again wrong-footed. Is it any wonder every participating central bank except the Fed and are surreptitiously accumulating physical gold?
All right. Now, Andrew, we had a lot of questions about the Fed being so wrong-footed. How do you see this playing out here moving forward?
Yeah, Shane. Speaking of the Fed, let's just see why the Fed is the only central bank that has got gold so wrong. No one's really drilled into this. Multiple high-respected Fed insiders, some of them who I've interviewed here in Live from the Vault episodes over the years, all concur that the Fed does not understand gold. Agreed. In fact, every report we hear, bar none, indicates that the Fed never discusses gold, that it's simply not on their radar. However, recent footprints tell us this is no longer strictly true. And this recent US dollar downgrade that we just experienced just underscores it, really cements it. First tier liquidity provider aside, it indicates that following Basel III NSFR conditions turning gold back into a first-tier asset class on the 1st of January, and for all the wrong reasons, gold did appear on the Fed's radar for the first time since Nixon ended Bretton Woods' system of fixed exchange rates for gold. Now, it cannot be ignored that for the first time since Bretton Woods was slammed shut over 50 years ago, that following gold becoming a first-tier asset class, gold once again reared its head to compete against all-hallowed treasuries. And as we highlighted last episode, during 2022, bonds suffered their worst ever performance since Nixon pulled the dollar's exchangeability into gold, while simultaneously it's not going unnoticed that central banks, sovereigns and institutionals seeking an alternative safe store of value are diversifying out of US treasuries into competing zero counterparty risk, competing first-tier asset class physical gold. So gold as a competing first-tier asset class now undoubtedly has the Fed's attention. And this catches them snookered and on the back foot. And given the ballooning level of the US and related global bond market debt, it's ultimately telegraphing a future US Treasury default. There is no doubt about that. We are now witnessing a slow but steady move by central banks and sovereigns bleeding their investments into the only first-tier alternative liquid asset class that has zero counterparty risk, less risk than treasuries. Physical gold and ultimately related silver, and further down the road, the food chain, is going to be hard commodities, but it starts with gold. The Fed is now recognized as the only buyer of treasuries in any size. And given first-tier physical gold directly competes with US Treasury demand, the Fed-induced, ill-conceived paper gold battle continues for, again, all the wrong reasons. This stepped up, as we say, after the Fitch US downgrade. But these official pushbacks against gold are running up against an increasingly divergent, very strong global demand physical gold marketplace. Now, published and on record, central banks from 22 onwards, in anticipation of Basel III NSFRs creating a far too onerous structure to swap and lend out lease gold, it just didn't make sense. Footprints evidence these same central banks, including the Bank of International Settlements, have bought more physical gold than at any time in history. But as we've been drawing attention to, only some of these central bank gold buying inflows are actually visible. Our central bank accumulations of monetary gold just don't need to be reported. And it's these accumulations that by deduction help us to assess that the integrated Sino-Russian central bank alliance have accrued at least 4 times as much physical gold as the 8,133 tons of treasury gold. Furthermore, there's empirical evidence that the treasury gold is rehypothecated, double owned. And you only just have to reference the inability to immediately fulfill the 300-ton Bundesbank repatriation request in 2013, alongside the refusal to allow the Bundesbank to inspect their assets. My God, so no audit allowed. I mean, give your head a shake. And as we've been drawing attention to, this leaves the Fed as the sole outlier, the only central bank still capping bellwether gold as it competes against freshly printed, Fed-controlled dollar and treasury supply. And of course, any asset class or foreign exchange cross that impacts the global desire for treasuries, of course it has the Fed's attention. And as I say, for all the wrong reasons. And just like they're driving US treasuries into an ultimate debt-related default, they have got gold just so wrong. However, what we see flowing out through the EFP backdoor, we talked about the exchange for physical. That is the backdoor where the COMEX, siloed COMEX exchange, paper market gold can flow into the deliverable over-the-counter markets, which obviously most US traders are not able to trade. So these because they're flowing out through the back door, official gold capping efforts seeking to bolster illusionary demand for the dollar and US treasuries are increasingly constrained to how much inversely sold paper gold can be contained inside this siloed cash-settled COMEX exchange. They don't want it to leak out the back door. They don't have it to deliver. So really, that creates an issue. And we've also been drawing attention to the LBMA fix, how it's contained to just a few siloed LBMA players, hence the relatively low volumes in contrast to much larger global bullion movements. Yet in contrast, outside the CME LBMA ring fence, insiders know that this fix is actually used to set prices outside the local London and to capitalize on it off grid, ultimately tightening supply as these Bretton Woods-like fixes, providing the ability, as we say, to alchemize paper gold into physical at the daily, far too cheaply fixed prices, which have been diluted by the COMEX, tail wagging the physical dog. Look, people understand these gold prices do not reflect true supply-demand fundamentals. In other words, the gold to dollar denominated asset suppression game has changed and it's being preyed on. And Shane, you remember how in our last episode we drew attention to the Fed being pressured into US compliance with Basel III NSFR standards. The final implementation of the Basel III international regulatory framework for US banks is on the front burner. It was going to be tabled the day after we did our last episode. And while we do expect, and did say at the time, we do expect the usual pushbacks, these NSFR standards will definitely impact the large whale US-centric COMEX banks acting as market makers in gold futures. Wait till they're downgraded as well. And the Basel III proposal will actually bring the United States into compliance with Basel III risk capital requirements for all banks with 100 billion or more. And that includes banks that are about to get downgraded. This includes the Fed agent banks, what we're saying, the cartel. It means implementing a standardized approach to calculating credit, trading, and operational risk. This will halt the ability for the banks to craft their own models, which is currently what they're able to do. And they just report in a very delayed way that it's happened, and they cover their footprints. And as far as gold's concerned, bringing the US futures exchanges into compliance with interchangeable spot gold FX NSFR conditions will limit the amount of COMEX leverage able to be employed inside the siloed COMEX paper settled exchange, which will assist in removing one of the last levers employed to artificially suppress the gold price versus the dollar. And what this means is that the already Basel III compliant over-the-counter longs, the ones that are looking to holding the physical, specifically the bullion that hedges the leveraged COMEX shorts, so it's there, but it's hedged in a short contract. What it will do is limit the unlimited leverage to just what can actually be squared 1-to-1 against COMEX speculators. Otherwise, it impinges on the first-tier banks, which are not going to do that. As the largest published above-ground store of bullion is tracked, as we said, by the GLD illusionary exchange-traded fund, and that the COMEX positions can actually be squared, even though they're leveraged 1-to-1 against the ETF. I mean, look, it's going to create it's going to make it much more difficult to naked short this illusionary these GLD assets. There are so many ramifications to the US becoming Basel III compliant. So pretty much in summary, gold has become a competitor for those seeking really an alternative to high counterparty risk treasuries. The Fed will have to adapt, or the dollar and bonds will reach a globally driven inflection point where, relative to gold, treasuries and the dollar debasement risk will accelerate. Well, every well-connected liquidity provider and first-tier bank we speak to assess full Basel III COMEX market compliance will be forced by the end of the 2023 trading. So the question is, where does it leave the Fed? Well, there's only one equitable backdoor other than a global nuclear war. With first-tier gold threatening to increasingly undermine US treasuries, the time will come where the Fed's only backdoor out of the box they've painted themselves into will be to revalue treasury gold from $42 to market. So every other central bank has a gold revaluation account and would equally be forced to pull the trigger, creating a tsunami of demand. Now, could Glasnev's gold back BRICS currency, or could it be a German Bundesbank triggering a gold revaluation first, triggering every other bank to do the same? It's ultimately just a question of when, not if, this happens. Whenever the trigger point, whatever the trigger point is, liquidity providers figure somewhere close to $2,000. And once the central bank gold revaluation is triggered, the rest will be forced to follow. And the aggregated globally revalued gold price would immediately drive the offer to sell physical gold much higher. In other words, I'm not selling it to you at this price. Now, given the paper to physical structural unwind, at best estimate, we've done a lot of research and chatted to liquidity providers about this. Revalue that at 2,000. Then probably you get a $500 buffer above 2,000 as the price, the paper to physical battle gets resolved. So somewhere 2,500 perhaps or thereabouts. Then what happens? A physical gold price is going to emerge. So from this point onwards, all global fiat currencies to some degree would be partly gold backed. And the central banks with the highest gold backing as a percentage of currencies issued would relatively be the strongest currency. A higher gold price is versus the dollar, and it would turn all fiat currencies. It's going to, it would suit central banks to have a higher price. This would actually be the most equitable pushback, or indeed an alignment with Glasnev's outlined BRICS Plus partly gold-backed currency. It all seems to fit together. So as a final sum up, as we progress through the thinly traded 3 weeks of August, which is kind of where we started looking, very short term, we may still see some short-term official pushbacks against the US and banking downgrades, and there's more to come, but we also see the downside momentum reaching similar extremes as was seen into the November 1818 lows. Now, outside the casino, T+2 physical outflows should assist in keeping dips from here on shallow and physically driven into morphing it into a sell the rally market, into a buy the dip market. So once again, we would expect that to evolve as we would. But this time, far less speculators are going to be vulnerable. And while this gold-backed new world order develops, do you think it's a good time to be on the sidelines? The only question is, really at this point, the only question is, how much physical gold and silver do you own now?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our entire Live from the Vault community, buy physical and make sure it's backed 1-to-1. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button, by sharing. And if you haven't already done so, subscribe, not now, but right now. And you can click on that bell if you want to be notified as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.